Now that we've covered the basics of financial markets, risk and return, the economic purpose of financial markets, right, is to bring savers and investors together. That's why they exist. We're now going to simplify all these markets. We talked about stocks and bonds and all kinds of different characteristics. We talked about treasury bonds and municipal bonds. Okay, all that is going to be simplified into one market, and we're going to call it the Loanable Funds market. Loanable funds, that's it. Okay, but first, unfortunately, we got to look at some identities. Remember the circular flow model where GDP was equal to national income? We're going to call income Y. Okay, I is taken, it's investment. So I guess the next thing to an I is a Y. So Y is equal to national income. And as you recall, GDP is the value of all final goods and services. And the income received from the production of those final goods and services is called just income. So GDP and income are equal. Now, to this point, we've mostly focused on GDP in terms of spending. All that spending on the output flows through and becomes income somewhere. Thus, GDP and income are the same. Well, we're going to look at this as income now. And so, instead of saying GDP is equal to C plus I plus G, we're going to say income is equal to C plus I plus G. Now, notice I didn't put this, plus net exports. Well, we're going to simplify it just a little bit more. Just to keep it simple, it doesn't matter. The result's the same. We can illustrate the same thing without it. But we're just going to assume a closed economy. That means no exports and no imports. Okay. So income equals consumer spending, investment spending, government spending. All that spending equals GDP, which again equals national income. Well, now we're going to subtract C and G from both sides. Subtract it from that side. And I'm running out of room here, so I'm going to bring it down here. So all I did here was I subtracted C and G from both sides. Again, basic law of algebra. If you do it to one side, you got to do it to the other. And that equals, well, C minus C is 0. G minus G is 0. So all we have left on this right side is I. So what we have here, Y minus C minus G equals investment. Well, what do you call it when you have income and you subtract from it your spending? What is that called? Let's say you have $100 of income and you spend 90 of it. You've got 10 left. What do you call that 10, the part that you didn't spend? You call that saving. Sure enough, we've got income minus consumer spending minus government spending. What's left? Saving. So what we find here is that saving is equal to investment. And that makes a lot of sense. Think about it. How is there going to be any capital investment if there's no way to finance that capital investment? What is capital investment financed with? Savings. Capital investment certainly cannot exceed savings. So here we've got them. We show that saving is equal to investment. Okay, easy enough, right? Yeah, right. Easy enough. Not saying it's the most interesting thing in the world in economics, but you know, I thought that was pretty good. Okay. Now we're going to do something else. Let me go back and write savings as this, y minus c minus g. Okay, that's savings. And, well, time out here. I'm going to need a little more room. Equal investment. Okay, that's just what we had up here. Okay. I just put it down here because now we're going to do something else. We're going to add 0 to both sides. Now, if I add 0 to both sides of the equation, I don't change the equation, right? 0 plus anything is whatever it was before. Okay. I'm going to go ahead and I'm going to add t, and I'm going to subtract t. And I can do it over here too. Add t, subtract t. But we already know that t plus minus t is 0. Whatever t is, doesn't even matter what t is. We know if we add it and then subtract it again, it's 0. So why are we doing that? Well, because what I'm going to do is I'm going to take this and I'm going to plug it in over here. By the way, t is taxes. So I'm going to say y minus c, and I'm going to bring this negative t, move it over here using the commutative law of addition, right? Everyone remembers that. I can move stuff around. I can put it in any order I want. See, that's the thing. I can put these in any order I want. It doesn't change anything. And then I'm going to, I think it's the associative law. These are going to associate together. I'm going to kind of put those in their little club there, their little group. And then I'm going to bring this positive t, and I'm going to put that in front of the g. And put the minus g over here. And then I'm going to have these associate together. And I only did that to the left side of the equation. Remember, we got that equals I over here. So since we know that savings equals investment, this is true. This is it. This is what we're doing. And all we did was we messed with this side of the equation. So here's investment over here. So what is all this? Just another way of saying savings. But we're going to split savings, obviously, in two parts. Here we've got income, and we're subtracting from that consumption, and we're subtracting from that taxes. So introducing taxes to the world, that is what we call private savings. Now, what is taxes to the government? Well, that's income to the government, right? That's cash inflow here. Government spending is cash outflow. So if you want to call taxes received by the government income, government spending, spending, income minus spending, that we would call public savings. And we add these together, private savings plus public savings, that equals total savings, and that is equal to investment. Now, this here, if this is a positive number, we say the government, well, let me write that. If that is positive, okay, let me print it. If that is a positive number, we say the government is running a surplus. If it's a negative number, meaning G is bigger than T, spending is bigger than tax revenue, that is a budget deficit. The government's running a deficit. They are spending more than they're bringing in, and where do they get the part that they're spending that they're not bringing in? Where do they get this excess? When they spend more than this? They borrow it. They go in and they issue treasury securities, treasury bonds, treasury notes, treasury bills. Now that we have private savings, public savings, total savings, and investment all figured out, all organized, now we're going to look at the loanable funds market, or the market for loanable funds. And guess what? We're going to draw supply and demand curves. Anytime there's a market involved, much of the time we draw those curves. Okay. The market for loanable funds. And over here on this axis, we're going to have the quantity of loanable funds. Okay, remember, that's loanable funds. And on this axis here, we're going to have the price of loanable funds. The price of loanable funds has another name called the interest rate. Now, for decision-making purposes, we're talking real interest rates. We make our decisions based on real interest rates, not nominal rates. Remember, real interest rates are inflation-adjusted rates. That's what's left over after inflation. So if your nominal rate is 5%, and inflation is 2%, your real gain on the amount of money you have, if you're saving, is 3%. That's a slight simplification. If you take a finance course, you got to introduce compounding in there if it's for more than one period. And so this is just a simplification as well, but that's okay. That's beyond this course. And it's not important to this course, more importantly. All right, let's talk about the demand for loanable funds. Who demands funds? Who needs the funds? Who needs other people's savings? Investors. There's the demand for loanable funds, just like anything else. Slopes down. When interest rates are high, those funds are expensive. It's expensive to borrow at high interest rates. So not a lot of borrowing going on. If there's not a lot of borrowing of funds going on, guess what? There's not a lot of capital investment going on either. And that's a problem. If interest rates are low, quantity demanded of loanable funds is higher. And why are they borrowing those funds? Why are they going to borrow those funds and pay money on them? Because they've got some capital projects in mind and they need the financing. They need the funds to pay for those expensive projects. Now, who supplies these loanable funds in the market? Where do they get them? Well, they get them from me and you, our savings. And that slopes up. Yes, at low interest rates, we're not interested in saving as much. We'd rather buy than save. However, at high rates, current consumption becomes kind of expensive because what are you giving up? You're giving up that high rate, real rate of return. So current consumption comes at a high cost of consumption in the next period. So high rates, yeah, we'll cut back on our spending and save a little more. So that's an upward sloping supply curve for loanable funds. And of course, we're going to put them together and we're going to have an equilibrium. Here's our equilibrium real interest rate. And here is our equilibrium quantity. And where the equilibrium is, we know that savings, modeled by the supply curve, is equal to investment, modeled by the demand curve. As we talked about in the last chapter on productivity, we talked about the basic characteristics needed really to get productivity, create the environment. What government can do to create the environment. All right? So we talked about, government that's not corrupt. Okay, we talked about property rights, well-defined property that can be enforced, a legal system where contracts can be entered into and enforced. Doesn't do much good to enter into them if they can never be enforced. Okay, so, and then we talked about, well, what if government wants to get out of the wagon and push a little bit? In other words, they want to move this equilibrium that way. That would be the goal. Move the equilibrium this way so there's more saving and investment. More saving, more investment, higher economic growth, more productivity, all that. Okay? So what can government do to, let's say, get out and push and move this equilibrium this direction? Well, before we do anything, let's look at what will do it with these curves. Well, the first thing that will do it will be to shift the supply curve to the right. See? Shifting the supply curve to the right will move the equilibrium quantity to the right. Also, shifting the demand curve to the right, or shifting it out there, will also move the equilibrium to the right. So the goal here would be to shift the supply curve to the right and or shift the demand curve to the right. So let's look at policies that would shift. Well, let's start with supply. What will shift the supply curve to the right? Well, let's draw another curve. Here's supply. We want it to go that way. So what we want is at any given interest rate, at any given interest rate. Let's put in, well, you know, here's 2, 3, 4, whatever interest rate. Here, let's say the interest rate is 2%. Here's how much I'm willing to save at 2%, right there. What would make me save more at 2%? Here I am at 3%. What would make me save more at 3%? What would make me or you or all of us save more at any given interest rate? Well, lower taxes on saving. That interest you get on your saving, let's have lower taxes on that interest, and that will motivate people to save more. And we've done exactly that. You ever heard of an individual retirement account or a 401k or 403b, all these retirement accounts, right? 457. And then you've got the Roth. Boy, that's a super, well, we got Roth IRAs, Roth 401ks. The Roth accounts never, okay, well, the way the way these accounts work is they grow tax-free. You don't pay any taxes on them as they're getting bigger and bigger with interest and dividends and capital gains. But then when you withdraw the money, when you pull out the money when you retire, then you start paying taxes on it. Okay. Nice thing about the Roth, okay, a little bit of a deviation here, is that once the money's in the Roth, it is never taxed. That's why they're so popular. Well, okay, so if you have lower taxes on the savings, that's going to shift the supply curve out to the right. Now let's talk about what will shift the demand curve for savings out to the right. Here's a demand curve for investment, demand curve for saving to be used for investment spending. That's a D. So let's say 2, 3, 4. What will make demanders of loanable funds borrow more? Here's what they're going to borrow at 2% right here. What will make them borrow more at 2%? What will make them borrow more at 3%? Okay, what will shift this whole curve out to the right? Well, you probably guessed it. If it's a government policy, one thing that they have, the lever they can pull, is they can make lower taxes on investment. So at 2%, before the lower taxes, they were willing to borrow and invest this much. But now with the lower taxes, see, that makes their after-tax return higher. That's what they really care about. That's what you really care about, is the part you get to keep after taxes. So if they get a tax deal where they get to keep more of their money, well, yeah, that's going to increase the demand, shift that demand curve out to the right. So examples are the investment tax credit. So when firms, when they invest in capital goods, they can put that on their tax returns and get a tax credit. That's when a tax credit, you can take it right off your tax liability. Whatever you owe on taxes, a tax credit just comes right off of that. So yeah, that would do it. Lower tax rates, accelerated depreciation. Accelerated depreciation would be another way to do it. on their books, if they've got a big, expensive capital asset, it's supposed to last many years. Let's say that it's supposed to last 10 years. Here's $1,000, but keep the numbers easy. $1,000 capital investment is supposed to last for 10 years, so every year they expense, that's an expense on their income statement, and the expense lowers their taxable income by $100 every year. But let's say they let them accelerate that depreciation. The true economic life of the good is 10 years. But for tax purposes, they'll let you depreciate it over 5. So they get to take $200 in expenses every year, and when they subtract those bigger expenses, that lowers their taxable income, lowers their taxes. Okay, so that'd be another way. Accelerated depreciation, we've got investment tax credit, and so those would be ways to stimulate demand for loanable funds and increase investment. That's the goal, to increase investment. Don't lose sight of the goal. Greater investment, greater economic growth, greater productivity, greater standard of living. So let's put that together. Let's put the curves together and see what happens. I'm going to throw a curve at you. What a guy. I warned you that I'm going to throw a curve at you, so it's not much of a curve. There's our equilibrium interest rate. There's our equilibrium quantity. Again, let's remember, this is the loanable funds market. And let's say that the politicians decide that companies are not investing their money the way they would like, okay? It's not working out. They would rather tax those companies and government have control over how that money is spent. Okay, whether that's good policy or not is another matter. But let's look at the economic consequences. So which curve is affected? Well, we're talking about, let's say they do away with the investment tax credit, and that one actually that has come and gone several times. That is constantly coming and going, being added, being repealed, being modified. Let's say it's being repealed. No more investment tax credit. Well, investment tax credit, that's the firm. That means the firm is not getting to, their return on investment is not going to be as high. The firm, they're the demanders of loanable funds, so it's going to affect the demand curve. So once we've just determined what curve it's going to affect, now which way does it shift? Well, their returns on investment have gone down. Are they going to demand more loanable funds and invest more when their returns have gone down? No. Less. The demand curve will shift to the left. New equilibrium, ceteris paribus, all else equal. Real rate of interest will fall. And less saving, less investment, less economic growth, the whole bit. The equilibrium moves to the left. Now, let's suppose the same situation. Well, no, different situation. Whole different situation. Kind of the same idea. It's determined that not everybody's saving that much. all these incentives to save. And the idea was to kind of help the common man, right? Well, the common man's out there blowing his money, right? All too often. And only higher income people are taking advantage of these incentives. Well, let's get rid of that preferential tax treatment on savings. My goodness, it's being squandered. Okay, which curve are we talking about? We're talking about lowering the raising the taxes on saving. Well, the suppliers of saving, okay, the suppliers of the funds, it's going to affect the supply curve, and it's going to shift it to the left. People will save less. You know, they were saving what they were saving in part because of the after-tax benefits of the saving. But if you take away the tax benefits and you have to pay more taxes on your interest, well, you know, you're not going to save quite as much as you did before. So we got the supply curve shifting to the left. And we have a new equilibrium. Equilibrium rates go up. Equilibrium quantity falls. We got savings and investment, lower savings, therefore lower capital investment. You can't have more capital investment than there are savings available to finance it. So, lower economic growth. Okay. Well, one last little thing here. Also, what will affect the supply and demand, and this one's a little bit tricky. It's not as intuitive. So it depends whether or not the government runs a deficit or a surplus will affect, well, what will it affect? Which side of the curve was deficit and surplus? We're talking about this here. Surplus, deficit. We're talking about this. If G is bigger than T, they're running a surplus. Just testing. If G is bigger than T, it's negative. They're running a deficit. So be careful. And what does this affect? The left side of the equation, savings. This will affect public savings, which means it's going to affect total savings, which means it's going to affect investment. So whether or not the government runs a deficit or a surplus affects the supply curve. It affects saving. Here, this side of the equation is the supply curve. This here is the demand curve. So we're talking about the supply. Okay. Let's say this is year 1, year 2, year 3. And this is T, this is G, T minus G, and this is deficit or surplus. Okay. Well, let's say in year 1, tax revenues are 100, and government spends 100. That is what we call a balanced budget. They brought in, they didn't spend any more than they brought in through taxation. Well, what happens to saving? There's private saving. There's public saving. And that equals total saving. And keep in mind that is all equal investment. So, we don't know what private saving is here. We're going to keep taxes the same. So it's not affecting private saving. Keep in mind that this number is this number. The expense here, the cash inflow here. So, public save, let's give it a number. You know what? Let's say private savings 20. And public savings is 0. So total savings equals 20. And therefore capital investment is going to equal 20. And so on our supply curve, supply and demand curves, 20. There we are. That's what that looks like. Okay, now, let's say in year 2, taxes is 100, and government has increased spending to 110. So 100 minus 110 is minus 10. Now they're running a deficit. What has happened to total savings and therefore capital investment? Well, this is now minus 10. Okay, this number comes from here. So 20 minus 10, and so total savings is now 10. So what is capital investment? It is 10. So in our graph, so what has happened to the supply curve? Again, we're talking supply. This is the supply over here, savings. This has gone down, so the equilibrium has moved this way. The reason it moved that way is because the supply shifted to the left. So if government runs a deficit, the supply curve shifts to the left. There's less. Okay, we can see that. See, it used to be 20. This used to be 20. It was here. Now it's over here. And the next year, same thing. They have run another deficit. Okay, that's going to shift the supply curve to the left. So, another term, deficit and debt. In year 2, they ran a $10 deficit. They had to go in the market and borrow $10. Year 3, they ran another budget deficit. They had to go into the markets and borrow $10. The debt after year 2 was $10. But after running another deficit of $10, yes, the deficit was 10, but the debt, the total debt, is now 10 plus 10. And if they keep running a deficit every year, the debt gets bigger. That's a common misunderstanding of the difference between deficit and debt. Some people think they're the same thing. A deficit is the yearly shortfall. The debt is the sum of all the previous year's deficits, plus the interest owed on that debt. Okay. Well, I think we did it. I think we got, yeah, well, here, important term here. in this case, when this happens, when government runs a deficit and therefore shifts the supply curve to the left like this, total savings falls, which means capital investment falls. So because of that deficit, because the government went in and borrowed that money's not available for firms for private investment. Therefore, we say that, in this case, public spending has crowded out private investment. Okay? The savings weren't there. So that's what crowding out is. It crowded out private investment because the government ran a deficit. And are we running deficits today? Oh boy, are we ever. Got sky-high debt. You know what? Interest rates are low. Federal Reserve Bank, we'll talk about all this later, just pumping out the money, just pumping it out, trying to stimulate the economy. Okay, more later about that. And yet, so it's there. Interest rates are low, but as we'll find out later in the semester, inflation is a concern. It's not popped out yet, and for all you know what? The pandemic may have prevented inflation. Okay, we're looking for good, and it's hard to find any good, but it may have saved an inflationary spiral. Who knows? As the economy was roaring along before the pandemic, the pandemic shut it down. Maybe that inflation that we've been bracing for because of huge amounts of money supply, trying to stimulate. Well, we shall see. So not a lot of crowding out right now, even though deficits are high, but over the long term, okay, remember we're talking long term here. Yes, savings not available to the private sector has been crowded out if government runs a deficit. Okay, I think we did it. I think we just successfully completed chapter 26.